Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Hello, welcome to the podcast. It is Tuesday, August 28th, 2018. We're doing it a day later today. I had to wait. I wanted to wait a day so I can get a guest that I really thought you would enjoy on the podcast. And being the summer and travel and stuff, it just yesterday couldn't happen. I hope you had a good weekend. My weekend was great. I painted all weekend. Yep. I spent 2 days painting my daughter's bedroom. My wife told me we built a house a few years ago, and when my daughter was younger and it was more childlike, so she's going into high school now. My wife said she could redecorate her room, and so I pay no attention to that stuff. Just like when we built the house, I paid no attention to what wound up in the house. I just said to my wife, "You handle it," and she loves to do it. So, around the house, I typically will see people come and go, and workers sometimes for whatever. And hi, how are you? Nice to talk. I always have sit and talk to them and hang out with them. But I don't typically get involved in this. My wife does all that. But on this particular occasion, I noticed that there was somebody in the house I didn't recognize, and my wife had somebody helping her, and then my daughter decorate. I'm like, come on, it's a bedroom. But anyway, I didn't say anything. But so my wife was talking, and we were talking one night, and it came up with, the question I don't normally ask, but I've learned over the years now I do ask, is how much is this going to cost? And she told me, and I was like, oh, really? But I've learned also not to argue. So, but I knew something was up when she said to me, "Hey, honey, I've had 3 painters in, and I don't know, but I think it seems a little expensive." I said, "Well, for what?" For painting our daughter's bedroom. She said, "Okay." She said, they all want around $2,500. I said, "For a bedroom? What are you lining it with gold? What I don't understand." She said, "No, I mean, it just seems expensive." So I said, $2,500 to paint a, I don't know, 15 by 15 bedroom, 15 by 12. I don't even know. 4 walls, a lot of trim, woodwork, and the ceiling. And so she said, "Yeah." So she shows me the quotes, and it was appalling. I mean, it was just ridiculous. And I am as I've gotten older and I have a family, I'm sure like many of you, you weigh, is it what's worth my time and what's not worth my time, right? So and you weigh it versus what it's going to cost. So there are things, and if you've been listening to the podcast, I'm severely limited in that decision because I can't do anything, right? Anything mechanical, I'm an utter train wreck. I'm a deer in the headlights. I used to try. I always rolled up my sleeves and said I could do everything, and Lord knows I proved I can't. So my wife knows, just go get it done. And but stuff that I can do. I mean, I'm out there with my snowblower, and I'm out shoveling the sidewalk as I can. So if I can, why shouldn't I? It's good exercise. I enjoy it. It's fine, and it's easy. Not easy, but it's enjoyable. But on and the painting, normally she brings someone in, but it was egregious. I mean, we live in a nice neighborhood, right? It's a regular, but it's probably a little upscale. It's an upscale town, but $2,500. I mean, that room somewhere else, I mean, it's $500, $600, $700. And there are a few towns around where I live on Long Island where when the tradespeople come in, they just come in and PFA. They pull it from their ass what number they're going to charge. And they figure, well, okay, well, 1 or 2 of the spouses are working. One spouse is working, the other's home, the other's busy. They're not paying attention, and we're going to just jam them. And screw that. I'm not going to get jammed by anybody. I don't like it. I don't mind paying, but not when somebody's trying to hose you. So I said, I'm going to paint. And that's what I did. So I spent all Saturday afternoon, all of Sunday taping, the walls were a mess. I don't know how. It's a relatively new house, but with all the stuff in the wall, there are patches everywhere. So my daughter was freaking out. She's like, "Dad, you don't know how to do anything. Anything. You can't." She's like, "Yeah, stock stuff, yeah, and all that. You could snow blow, but you don't know how to do this." Let me tell you something. I crushed it. I nailed it. I patched, spackled everything, trimmed out it all, did it. Dark blue on the ceiling. I know, but don't even ask. But Dove white walls, oil on the baseboard, got it. I could barely move today. It's so, I work out. In the winter I put on the 15 pounds, but I took it off already, and I'm in okay shape. I have muscles I didn't even remember I had. How is that possible? Just painting 3 coats on the ceiling with that dark color, it drove me nuts. But my traps, I mean, literally, I feel like somebody's sticking needles in me the whole time. My fingers, just from painting baseboards. I know it sounds ridiculous, right? But I just can't even get my head around it. As to these little things, feels great though. I love it. It's like a whole new workout. So I think I'm going to find new projects to do on a regular basis. But anyway, so that was my weekend, and we're back at it. And I was thinking about the markets, and I was thinking about I seen that the markets were up, hitting new highs yesterday, and because Trump dented hopes for a China deal after agreement with everyone was excited about Mexico, and then people thought that's good for Canada because if he agreed with them, he's going to ultimately come to an agreement with Canada. And we've got the whole China is going tit for tat with us, and there's a lot of stuff going on, and a lot of macro stuff, and we see the conference calls that are taking place. We're seeing companies starting to talk about their ability to raise prices, and they're kind of feeling good because it's been a decade since companies could really have any pricing power. So some manufacturers, 3M was one that I could think of that called out, hey, we're taking prices. And some packaging companies were saying that. And you haven't seen that, right? If you've heard me on the podcast, when I brought you through the anatomy of post-global financial crisis, it was no top line growth. Companies would cut costs like crazy to try and make their earnings growth. And then when they cut to the bone, then what did they do? They levered up the balance sheet, and the balance sheets, then they levered up, meaning they borrowed money, they put debt on the balance sheets. And with that money, a lot of them went out and bought back their stock. And when you buy back stock, you reduce the share count. It's an artificial boost to earnings. But what you hadn't really seen was top line growth. And then Trump gets elected, you've got the tax cuts, you've got a lot of money being repatriated, and you've seen a lot of stuff take place, and you've seen really good earnings growth. And you've seen, I think, this quarter, mid-20s earnings growth. So really strong earnings growth. But again, like kind of, what's really driving it? What's you like to see prices, and I love to see price increases because as an analyst, a price increase, if I could take 1 percentage point increase in sales that comes from pricing, it flows down more to the bottom line, especially in a manufacturing company, than does a point in volume. If I sell 1 percentage point more of the widgets I'm making, I've got to go buy the raw materials. I've got to produce it. I've got some waste. I've got labor that goes into it. I've got to put it on a pallet. I've got to ship it. There's a lot of stuff that goes on versus a point of price. Hey, Mr. Customer, your price is going up a point. What do you think matters more to profits? Exactly, price. But you've seen companies reluctant to do it. Now you're starting to see them tip their toe in the water. But rising prices could lead to inflation. And we haven't seen real inflation in a while. It's peeking its head up a little bit, 2 percentage points growth there. But so it's something to keep an eye on. But also, coming off the heels of 20 plus 25% earnings growth, right? So here's what I'm thinking and working through in my head. So markets hitting new highs, 25% earnings growth. Hey, Goldilocks is here, right? We have low unemployment. Of course, it's record lows. And we're seeing record earnings and prices going up. You've heard me talk before, though, about some of the consumer stuff that we're seeing. Some car loans aren't so great. The subprime sector, we've got student loan debt. You got a lot of stuff. Some banks are reserving more for credit cards. Again, not near crisis levels, except the subprime auto. But But just at a point in time, though, where you're starting, a lot of good stuff is priced into the market. And I wanted to bring a guest on today that was going to help us think this through. Because I'm really not sure exactly where it goes. I obviously, if you've been listening to the podcast, I'm cautious. I think the market's had a massive move. You've had so much good stuff priced in, and I think the risk is much more to the downside. I'm not calling for a global financial crisis. I'm not calling for a crash, but a major correction could be in store. So we're going to bring on a guest today to talk about that. I've had him on before. He's a former prop trader. He worked for Goldman Sachs for years. He now writes his own newsletter. Just a really smart guy. He also owns farmland, and he runs a private real estate investment trust. So has a great insight, very good geopolitical thinker. And we're going to talk through some of these issues. So without further ado, I will bring on Steve Koomar, editor of the Vigilante Investor. Steve Koomar, welcome to the podcast.
Oh, thanks. It's my pleasure to join you. Thank you.
Oh, you're welcome. You have a nice summer?
Very good summer. Very busy, very active, and so now it's time to got one more week before fall begins. Really, it's not really fall, but after Labor Day, then things get pretty active again. So it'll be fun.
Yeah, I was excited the other night. I took my dog for a walk, and I walked outside in shorts and a t-shirt. I said, whoa, I got to go get a sweatshirt. So I love that the fall was in the air here in New York. So, but it was fleeting because the next day it was 90 again with high humidity, but we'll take what we can get.
Yeah, exactly. Take that little reprieve.
Exactly. So Steve, let's talk, when I had you on last time, I got some really nice feedback from listeners, and it was great. You have an interesting background, and I'd like to just refresh listeners, maybe those who heard the last podcast, and maybe for new listeners. Your background is somewhat atypical in the sense that you have a lot of international investing experience, and you spent time in Japan, and you were on a prop desk. So just take listeners through, if you can, your background in investing.
Sure. I started with Goldman Sachs in the late 1980s in fixed income derivatives, and our focus was very much on providing a quantitative analytical product to institutional investors. I did that for a few years in New York, and Goldman asked me to move to Japan and run a business for them in Japan, which I did that. And after about a year, I was at a crossroads. I either had to come back to New York and kind of continue to do the same thing on the career path, or stay in Japan and start prop trading and manage a prop book for fixed income business in Japan. And I took the latter. It was a very interesting change. It was a huge step for me to really kind of operate on a prop desk in a market that was really very foreign to me just a year earlier. But
so you had a foreign market and a new total skill set you had to develop, essentially. Exactly.
Yes, that's what I had to do, and it was.
Can you just tell people who may not be familiar what a prop desk is?
Well, Goldman in this case, Goldman had a big business in fixed trading bonds and all the whole complex of fixed income products in Japan, and a prop desk. I worked with that desk, but what I had the ability to do was just take positions for the firm. I wasn't trading with clients. I was just trading for the firm's book, for the firm's profit and loss. Mm-hmm. And they gave me license to trade all of the fixed income complex in Japan, but I could also trade equities, currencies, other markets around the world. They allowed me to try to trade one market against another to the extent that I could. A lot of what I did was relative value trading within the Japanese market, but I did a lot of international trading as well. And it was basically to take advantage of the kind of the special knowledge and perspective that I gained from sitting in that seat to earn a profit for Goldman Sachs.
It's you got quite a view on all of that's going on in the different financial markets, and you're handling their P&L, and so people and prop desks have changed over the years, but let's talk about an investing framework, right? So here you are, you're starting out trading different markets than you're familiar with, and you're sitting on a prop desk and you're trading fixed income. You could take currencies. Pretty much, you could do whatever you wanted to do where you thought that you could generate a profit for the firm. So how did you structure an investing framework for yourself? And then if you can talk about the framework and how that kind of morphed into how you think about the world of investing today. Because I one of the things that has surprised me, Steve, for the first time in my 20 plus years of career is I have exposure now to retail investors, a lot of folks who listen to this podcast. And really, I have really nice interactions with them and with the subscribers that I have to the newsletter. And it's a lot of back and forth on emails and direct message on Twitter. And it's great. One of the things that I realize in talking with them or communicating with them via email and direct messages, if I would say one thing that has surprised me is not necessarily having an investing framework. It's hearing an idea and it might make sense or not. And when I started in the business a long time ago, I had to develop an investing framework, which kind of came from the firms that I was at. And over time, you morph and develop and kind of establish your own framework. So can you share with listeners how you've developed your investing framework and where it's led to today?
Sure. You always have a core that you lean on. When everybody has a core framework that they lean on, and my core was always value. Mm-hmm. And I could quantitatively analyze securities to figure out where the value is, and I could trade something that I could buy assets that I thought were very, very cheap and offset some of the risks by hedging it, either by selling other investment products that were expensive or just fairly valued, and try to capture that value. And then we would lever that up. That's what I did at Goldman, is we levered up those positions that we thought we had the greatest value in. And that was the core of what I did, is I found relationships in the markets where I thought that the odds were very strongly in my favor, that if I could sit on this position long enough, I would make a really good profit.
You're looking for asymmetry.
I'm sorry?
You were looking for asymmetry in the risk reward.
Absolutely. That's right. Asymmetry was exactly what it was. So that was the core of what I did, but you couldn't rely on one thing alone. And particularly doing that in Japan was difficult to do, because sometimes what made something fall out of alignment in terms of its market relationship might be at the very beginning, and it could get a lot worse before it gets better. And if you had a lot of leverage in that position, you could get pushed out of the position very easily. So I had to have other types of things that I did where there was asymmetry, and sometimes it was just outright market bets. It could be a volatility position. Because maybe volatility in currencies was very low and I could trade volatility there. Or I might trade volatility in currencies versus the Nikkei because there might be a relationship there that was off. So I would get into other markets or other places where I could find asymmetric bets and build a diversity of positions in my book. And that's a lot of what I do today. I do that in a lot of ways. I don't offset my risk and lever up my book by putting hedges on, and that's what a hedge fund would do. But I do look for value positions, but I also add to that. I look for growth, and I kind of modify what a normal growth investor does, and then I really look for growth that is not expensive to buy. Because anytime you're buying growth in the market, you're going to pay up for it in terms of price earnings multiple, or however you want to measure the pricing variability. But I I look to buy growth at the cheapest price possible, and so if I have a mix of growth and value positions in my book, and I also try to structure it where the most volatile positions the things that I think have the highest risk associated with them, I'll size them in a smaller position size than the things that I think are the least risky and the least volatile. Those I will size in a larger in larger quantities, but still never having really significant imbalances in the portfolio. Try to have a lot of different investment bets out there, so that because you never right 100% of the time.
Well, that's point number two that has surprised me over the last year is position sizing, which is just so critical. And like you in a portfolio, I might have there could be a wide range for me between my highest conviction idea and my lowest conviction idea, and it could be based on a few things, right? It could be based on just the inherent volatility of that position. It could be where they are in their cycle. Something can be deep in a bear market where I see catalysts evolving, but I don't think it's time yet. But I want a little exposure to the position, and I'll start small and scale into it as I continue to do my work and have more conviction. So that's one thing that it might be. And then I look at the risk reward. What's my upside versus downside? And so I do size positions differently. And that has been surprising for me, with people saying, okay, all things equal. And I think it is so important for investors to really understand the upside potential versus the downside loss, and then size accordingly. Rule number one, don't lose money. Rule number two, live to fight another day, because like you say, you're right. You're not going to be right all the time. And so it's interesting. So because I interrupted you while you were taking us through your Goldman Sachs and then your Japan prop desk days, how did it morph from there? What did you do after that?
Well, I went to work for Prudential for a while, managing a global fixed income book for them, and it was here I was investing for pension fund clients of Prudential, mutual fund clients of Prudential, and for the insurance company's general account. And here I had a book of international bond positions and currency positions, and had to manage. They would manage around an index, and your goal was to beat the index. Mm-hmm. And so I had a lot of I really had exposure to all the markets, all the developed and emerging markets, and that was a great experience. I did that for a while, and then the Prudential kind of went through some changes in terms of what they wanted to do in international markets, and I moved on to a fixed income fund of hedge funds, and developed a business there related to basically putting together a portfolio of different hedge fund strategies within one bigger portfolio for large institutions.
And that's interesting because you get to see all on a global basis. You get to see all the different hedge funds and meet and interview the managers. And it's not only understanding their investment strategy, but doing the due diligence on their business, right? Understanding whether or not it's a viable business, or understanding the processes they have in place. So, but you also get to see some really great minds and some not so great minds. But really, that must be a fascinating position because, as a manager, I've always been on the other side of that. I've always been the one fielding the questions from the fund of hedge fund managers, and I can tell pretty much quickly whether somebody really understands what they're doing. And it's not a coincidence when you walk out of a meeting and the guy on the other side, or the woman on the other side of the table who's really put you through the grinder, it tends to be, you tend to see they're ones with great performance. So it's pretty consistent there. What was your experience like in the fund of hedge fund world?
It was interesting. Many of these strategies were very complicated, obviously, and they required an incredible amount of analytics. But
right.
The best, most consistent performers could explain their strategy in one or two sentences, and it basically the people that had very, very logical grasp of what they were doing, and they could distill it down to something relatively simple. Those are the ones that were the most consistent performers. And the thing that gets everybody is, you go through and it got fixed income really badly around the financial crisis, is that leverage can be dangerous, and you get too much confidence around your ability to hedge, and it can be fatal. And that was a lot of what was behind the financial crisis, really. It was just too much leverage built up around relationships that people thought had been working for the last 20 years and would continue to go on forever. And there was a dislocation, and it was the end to so many of those managers.
Yeah.
But yeah, I think that simple logic prevails. That's what I learned from that more than anything else.
Yeah, it's interesting. Throughout my career, we've had investors from all over. We've had them domestic investors who invest in the hedge funds, European and Asians, and I do a lot in the uranium space right now, and it's interesting how I was just over in Asia, and I was there visiting some people, and I also met with some fund of funds, some allocators of capital to some of the uranium strategies that I have, and I've spoken with U.S. investors on nuclear power and uranium, and many European investors, and then the Asian investors. And for the Asian investors, the growth in nuclear power is taking place in Asia. That's where all the growth is coming from. So when I would sit across the table from a capital allocator, I didn't have to explain to them the case for nuclear power. And when I would speak to when I do speak to some European investors, I quasi have to speak about the case for nuclear power. But when I speak to American investors, they say to me, well, nuclear is a dying business. And now the Asians know completely that's not true. They know it's a growth business. And so it's fascinating to see people's own experiences, even though we live in a global 24/7, always connected world. It's great to get out there. When I get out there and talk to these different people, I really get to see people's own personal daily experiences and what they see and read locally that shapes their views. And it's so interesting to me because I think as an investor, sometimes I have to, for any category I'm looking at, I have to always ask myself, I see the thesis, I see the drivers, the catalysts, but what am I missing? It's a big market. Who's the marginal buyer of this security that's going to take these prices higher? And what's going to get them interested in it? And it helps me by meeting people from around the world, really take my blinders off and not be myopic in my view. And not just myopic in my view based on fundamentals, but based on the overall picture and who the investor base is. And so for me and for many, many years, I've invested internationally. And that's helped by going all over the place and visiting with people. But from your experience in Japan and working abroad, how has that shaped your view as an investor today? And what experiences do you think you could bring with it? Do you bring to it? And maybe for listeners who are saying, well, how did Steve know he was trading currencies, he was trading bonds? Where do you even begin to look? And people ask me, they say, how do you get your ideas? It doesn't come out of a computer screen. I mean, yeah, you can date them. And on my Bloomberg, I have them and I pop them in once in a while and I go, okay, yeah, I know the same companies are coming up. But for me, it comes from just being a voracious reader of stuff. whether it's geopolitics or whether it's history or whether it's current events in other parts of the world. It's just stuff. And you stumble upon things that kind of make sense. How do you, and how does your international experience, and how does that shape who you are today?
Yeah, that's a great question, Mike. I mean, I think that a lot of this started before I went to Japan, but because I've always been very interested in history and geopolitics. But Japan, my experience in Japan really ignited, sparked a real flame towards really trying to learn as much as I could and just devouring information and analysis related to geopolitics. And what I saw there, the effect while I was there of geopolitics on markets was enormous. I mean, there was a trade dispute that was going on between the Clinton administration and the Japanese government in the early and mid 90s when I was there, and the volatility that placed in the stock market, in the currency markets especially, and but also in the bond market there was enormous, and it really drove these enormous, very well developed markets. The geopolitics of that trade dispute drove the Japanese market and perceptions of where the economy was going. And I could see how critical that was. And over time, I've just studied and learned more and more about geopolitics. And when I talk about geopolitics, it's just not, policy is really important, but so much of policy and so much of who we are is formed by the geography of our people. Our cultures are really, really a product of the geographic advantages and obstacles that we face, and this is true of every society in the world. And as policies change in one country, they affect other countries, or as power differentials change. You know, the awakening of China has had such an impact on Asia and on the world. And the effect of just the U.S. military presence in that area, what that did to allow China to develop was just incredible. And so you see things like this, and it really has some big ramifications. As you learn about geopolitics, you can see how it just never the impact on the markets never changes. What actually is it's doing, what geopolitics is actually doing in markets is always changing. But the fact is that there's always impact on the economy and on the markets. And right now, probably more so than many times in the past, because you have an American president and administration that is bent on changing the the economic order that's existed for the last 70 years. And this is going to take a long time to play out, and it's going to have an enormous impact on all these markets going forward.
It's so interesting. I'm a geopolitical junkie, and no formal training in it, but just like you, for years and years and years. In my whole adult life, I've taken a keen interest in it, and with my uranium investing, it's one of the big, the number one supplier of uranium to the world is Kazakhstan. And they have the country is 41% market share. The state-owned entity has in the mid-20s in market share, and they're the 800-pound gorilla. And, it's a state-owned entity, and they have lower costs. And it's interesting to, one can always make the argument when in commodities or in anything that the state-owned enterprises have less economic discipline because you don't know what their motivations are for producing what they produce, and oftentimes it's to feed civil programs, and they got to just keep selling, producing and selling. And when years ago when I started really wrapping my head around the uranium space in Kazakhstan, I had always had a fascination with the Soviet Union, and obviously Kazakhstan being a former state of the Soviet Union. I remembered a book I read back. It was probably in the early '90s, and it was written in, I think, in the late '80s, and it was called Perestroika: The New Thinking for Our Country and the World, and it was written by Gorbachev, and it was. At the time, it was a fascinating book, but I recalled I wanted to get years ago when I was getting really familiarizing myself with the Kazakh environment, with the economy, with the political situation. I recalled back and being the former state of the Soviet Union, I went back and I read that book, and it gave me the insights into what they were thinking. The guys running this country now, or the guy running the country, and the state-owned entities, where they came from, because they were still being run, even though the Cold War had long ended, even though the Soviet Union had long disbanded. It was being run by people who grew up in that Soviet era and were trained in those schools, and so. Having read something 20 some odd years ago, I was able to go back and revisit it and read it again, and it kind of puts you in the mindset of where we are today. And I think often when I speak to investors, sometimes they'll say, Kazakhstan, they're just going to produce whatever they produce, and that's it, right? And it's a throwaway line, and that's the thought process that goes into it. But I think having an understanding of geopolitics and why things happen and the moving parts and how they connect is really so important. And it's never too late to start if you're not a fan of it, but you are an investing fan, I think, and you want to be an investor. I think it's so important to really have a sense for what's going on around the world. And I know I read your stuff and you do such a great job at it. You really put the pieces together. So I love reading your stuff on that. Speaking of that, let's talk, if we can. I mentioned I was just over in Asia, but let's talk what's going on with China. And I know you've had some views on the trade wars, and I have been surprised by the Chinese really digging in. And I know you have some interesting views on that. And what we've seen is that they're going tit for tat with us. The more we put tariffs on, they're matching it. And on the surface, you wouldn't think that that's something they could actually win. So why don't you talk about what's going on the Chinese trade side? And I bring that up, especially in light of the agreement that was signed with Mexico, I think just a couple of days ago, where now the Chinese want to come to the table, and Trump is kind of saying, yeah, I don't have time for you right now. I'm focused on other stuff. So talk about, if you can, what you see going on in that part of the world and what's going on with the Chinese and the U.S. and all this trade war stuff.
Sure. I think that's the biggest factor out there in the global economy right now is what's going on with China and trade with the U.S. I think, I really expected when this whole discussion about changing the terms of trade, when Trump first introduced it, I thought China would seek an agreement with the U.S. quickly, which would they would see the handwriting on the wall. I mean, their economy is so dependent on exports to the U.S. And they don't really import that much from the U.S. They have some agricultural products, some intermediate goods, but some services, but it's really not that much that they import from the U.S. But they really need access to the giant U.S. economy to keep their economy running. They have to keep selling goods to the U.S. And so, I just figured that they would play ball, that they would understand that they would have to make an agreement that would come to terms with an agreement that would maybe give them a little less of an advantage than they've had in the past. And their advantages are significant. It's not just in terms of dollars and cents, which they are big in terms of dollars and cents. They have bigger tariffs on strategic goods than the U.S. has. Or other countries, really, for that matter. And they also have a value-added tax, which the U.S. does not have, and that value-added tax of 17% acts as a 17% tariff, basically, at the border for all imported goods.
Right.
So they have a pretty significant advantage in terms of the total tax structure that they have, and in addition to that, they have a lot of non-tariff barriers in terms of how they deal with inspections, and they also require, joint ventures for many businesses that want to do business there and giving up intellectual property. And they also engage in a lot of cyber espionage. So there's a lot of ways in which they gain technology that wouldn't be considered very fair in a Western economy. But to them, I think it's quite fair. So they've really developed some significant trade advantages in the past, and I thought that they would just be willing to give up some of that in order to get an agreement and keep things going, and maybe accept a slightly lower growth rate going forward. But they have decided to dig in, and and they have tried to go tit for tat with the U.S. and they have to the extent that they could, but they just don't have that many goods to tax in terms of imports. They have so many more exports, and so what they've resorted to is a pretty clever strategy of trying to influence the coming U.S. midterm election. So they have really pressed their bet in terms of hitting the agricultural states that are a really important part of Trump's support base. There are a lot of important Senate elections. There's also a lot of important House elections in those states. And if the pain from a trade war in those states can cause a significant swing to the Democrat Party in the midterm election, Trump will really probably lose a significant amount of his ability to kind of push his agenda going forward, both in terms of not having the congressional support, but also it would just he would just be have to backtrack and find a new strategy and a way to govern going forward. And I think that's really what China is banking on. They would like to damage Trump enough to where he doesn't have the strong negotiating position that he appears to have now.
Well, you point out that in the majority, I think you said 34 billion of Chinese tariffs hit the agricultural sector, and 14 billion of that goes to soybeans, and which is like a third of the U.S. soybean production you had pointed out. And you have personal experience with soybean production. I mean, you own farmland, so
I do. Right? I own farmland and I share crop it, so I'm literally a soybean producer myself.
So it's right, yeah. So talk about. I mean, what are you seeing out there? What are your farmers who are renting your land? What's going on the ground?
It's a bad year in terms of price, and many farmers hedged their bets going into the year and sold some soybean production in advance, and so it's not like they're going to bear the full brunt of the pain of this. But a 20% drop in your price is a lot when you're already operating on a low margin.
Right.
So it really does mean some losses for many soybean farmers. And that will be offset a little bit by really great production. It's going to be pretty much a record year in terms of crop yields this year, and that will offset some of the pain.
Mm-hmm.
But right now, really for the most part, there's a lot of dissatisfaction and grumbling, but not anybody that's really willing to, make significant changes. People are still kind of moving along with the status quo. I don't see any signs of this affecting people's votes, but it may affect whether or not they actually go vote. So I think that it's really a little bit up in the air how this is going to play out in these key states. And
so how do you think about? So let's say they do have, and China's playing the long game, right? They have time. They think in terms of 50 and 100 years. They're not worried about tomorrow. And when you think about informational warfare, if you will, right now, obviously, the Russians have a target on their back from Congress. You can't find anyone on whether you're watching the liberal talk shows or the conservative talk shows, excuse me, right? Russia's the target for everyone in terms of what's going on that Americans are suspicious of. But the Chinese are going at it, right? And the thing with the Russians, where they were influencing the vote, is what they allegedly did in the November elections for the presidential elections. This is just a different tact. We're trying to influence the hearts and minds of people. So if you think about what's going on and you think about the potential for change to occur, and like you said, policies could change, how do you translate that into market risk?
Well, I think that the markets have done very well under President Trump. Mm-hmm. There's been a significant amount of deregulation. You've had a big corporate tax cut. I think that has changed the combination of those two policy initiatives has put the U.S. on a somewhat higher growth trajectory going forward. And I think that is being priced, at least to some extent, in the stock market. If you start to take away the deregulation initiative, or if you think there's a risk that goes away, and if you think there's a risk that there's a reversal of some of these tax cuts, it will cause stock prices to decline. So there is a risk factor out there. If there is a significant change in government policy related to this election, it would severely damage stock prices. Just the threat of it could cause a correction. So I think about this and I go, I think the market has had a nice run. It's at pretty high valuations. I wouldn't say it's crazy rich, but it's not cheap. So to the extent that I have stocks that are pretty fully valued or have had a really nice run and there's a lot of good news priced in, I'm starting to take some risk off the table and add to my hoard of cash so that if we do get a correction, whether it be because of this factor, which being, something related to election fears and a change of government, or it would be the Fed, or it could just be there's a lot of good news priced in the market and it could go down when enough good news has already been priced in. Whatever it is, I think it's good to start to raise cash incrementally. I'm not like selling everything. I'm just selling the things that I think are pretty fully valued that maybe I wouldn't buy at these prices today, but I've been holding because they've been doing well and on a nice path.
So I want to stop you there for a second, and maybe we can help investors who are either new to it or they're caught up in they've been doing it a while, but they've seen 9 years of rising stock prices, and it's something that gets talked about a lot. But I want to drill down if we can. What you said was if I think they're fairly priced or fully priced. Right now, and a lot of we all use that terminology, and I know what that means in my head, how I'm thinking about valuation, and you know what that means. But regular, ordinary investors who have other jobs and other lives may have a nice portfolio of stocks that have done well. Help them think about how you think about valuation. For me, I think about it depending on the industry and the company. I might look at the price to earnings ratio and the growth rate and expected growth rate of that earnings stream. I may depend if it's a capital intensive industry. I may look at it on an enterprise value to EBITDA basis. I may look at it on a free cash flow basis. I look at it at different things and different valuation measures, and I'm always looking at what the expectations are for that whatever stream I'm looking at, whether it's at earnings or cash flow, and what and how that squares with where it's been in the past. How do you think when you're saying something's fairly priced? Help our listener sitting at home who is coming home, he's worked a full day or she's worked a full day, and now it's 8 o'clock at night and they're sitting down looking at their portfolio saying, okay, how do I know if it's fully priced? How do you think about that?
Well, I look at for instance, I look at a lot of growth stocks.
Yep.
Exactly the way you described it. I look at the price to earnings ratio, and I compare it to the expected growth rate going forward. And if you have a stock with a 10 price to earnings ratio, but it's got an expected growth rate of 15%, I think that's an exceptional value. I'm going to want to own that stock. That's that would be kind of about as cheap as you're going to find in this particular market. And I've bought some stocks with that kind of a profile, and they've done well. I think I did something very similar to that with Best Buy and with and one stock was Williams Sonoma, which had at the time it had something like a 8 PE and or 8 or 10 PE and a projected growth rate of double digits. And but now Williams Sonoma has just had some fairly good earnings reports, and it's triggered a lot of short covering. There was a lot of short interest in the stock. It still has over 20% short interest, and it got the prices where the price earnings ratio got to be above 17. And at that price, I said, you know what, with the earnings growth rate of maybe 8 to 10%, this isn't nearly as attractive as when I first bought it. I think maybe it's a good place to exit the trade, and I exited.
So here it is trading at 2 times its growth rate, which you're saying, okay, this is probably pretty stretched here.
Yes, exactly. And so that would be an example of a situation that of a recent case where I've exited the position because I thought it had a reasonable valuation on it. I wouldn't say that it's expensive. A 15 or 17 PE is kind of where the market is.
Yep.
But I could also look at that and I go, where's the rest of the market in terms of growth? I don't know, something around 10% probably right now going forward. I mean, it's been 25 the last year, but that's not going to be sustainable after the tax cut rolls off. So it's somewhere around market growth expectation, maybe a little below market growth expectation now, and but it's got a market PE. This isn't that exciting to me anymore. It's a great business. It's going to be a sustainable business, but I think maybe I could, if we get a correction, I might be able to buy it back cheaper. And in any event, I got that cash available to deploy on the best possible opportunity out there in whatever industry it happens to be.
Well, so you just mentioned growth. I mean, we've seen earnings growth of mid-20%, which is pretty stunning. And some of the things I'm wrestling with right now is we see the economy 4% plus, unemployment is at decades lows. Interest rates are low; they're climbing a little bit, but we're not seeing the wage increases that you might expect. But the thing that I'm noticing, and I've talked about this before on the podcast, is prices are going up. And when you listen to the conference calls, I think this quarter, some of the packaging companies, 3M, came out and said we're taking pricing up. And it seems it's easier now for companies to pass on raw material increases in the form of price increases. And they have been quite reluctant over the last decade. Companies have been afraid to move pricing higher for fear of losing customers to competition. Who blinks first? If I raise prices, will the others follow? Now, some of the retailers aren't. I think Walmart has kept prices and even dropped prices, but I'm seeing it in some of the manufacturers. And I think Pampers, P&G, they had a big price increase. I think it was 5% on Pampers. So if they're taking pricing, it's going to the retailer, and the retailer can either choose to pass that on to the consumer or to eat it themselves. And on the manufacturing side, on industrial manufacturing, I'm seeing more and more companies talk about, you know what, we're more comfortable taking pricing. rising prices leads to inflation. Now, inflation has been non-existent basically, but it's creeping up a little bit. But one of the things I like as an analyst, you like to see pricing because it has more of an impact on your operating margin than volume does. Because if I have to make 1 percentage point more of something, I've got to order the raw materials, pay people to make it, palletize it, ship it. There's a lot of stuff involved. If I take a point of price, I'd send my salesman into the corporate headquarters of my customer and say, price is going up 1%. That's a lot more flowing down to the margin line. So now the companies are getting comfortable, it seems, starting to take pricing. Have you given that much thought? And if so, do you think that the end markets can absorb price increases, or do you think that it's something that companies will try and then dip their toes in and see where it goes? And what's your thought on that?
Well, I think that's a interesting perspective. Indeed, there are industries where pricing power is starting to return, and those industries should perform pretty well if their pricing power is sustained going forward. At least until a point where the costs go up more than they can recoup in terms of their price increases. But
right.
I think we're at a stage in terms of tightness of the labor market and economic growth where it's inevitable where you will see pockets of pricing power, and it might expand and become broader across the economy overall in time. I think one of the checks on pricing power for a long, long time has been the global economy and the increasing globalization and the ability to outsource to emerging markets where labor costs are extraordinarily low and still ship goods very safely across the oceans, things that you could have never done 80 or 100 years ago.
Right.
And that has proliferated, and companies have gotten better and better. That has put downward pressure on prices. It's increased competition above and beyond what we were accustomed to in prior decades. But even, and I think some of the changes in trade, though, are that we're going to see where, you just saw an agreement completed between the U.S. and Mexico, and bilateral agreements will continue to get done, most likely, to be negotiated between the U.S. and Europe, between the U.S. and Britain, between the U.S. and China, hopefully at some point down the road. And that points to probably every one of those bilateral agreements that is negotiated is probably going to reduce competition in the U.S. a small bit on the margin. And so I think what you're looking at in terms of more pricing power is something that will pick up steam in the years ahead. And initially that will be good for the companies that are involved, I guess, one of those places is steel, right?
Yeah. Yeah.
And even without the tariffs, the pricing power had already started to come back. But with the tariff in the U.S., it solidifies it. I think you're going to get more and more of that, and I think in the near term, it's very good for those companies. In the long term, it's going to create an interesting dynamic in terms of monetary policy and trying to figure out how to fine tune that interest rate policy to keep a lid on inflation. And we'll see how that goes. That's something that we're going to have to watch and learn from. I can't really predict how it'll go.
Right. So what do you like right now? If I were to ask you, Steve, what is there a stock that or a sector or something that you would think that is, by your criteria, mispriced and is interesting to you? You want to share anything with the listeners?
I really like investing in 5G. And 5G is the next generation of mobile communications technology that's going to start coming out in 2019. It's going to when it's fully operational, which will take a few years to get it fully operational. It's going to increase capacity of the system by 1,000 times. It will increase speeds by between 10 and 100 times. It's going to create so much more usage of the mobile technology infrastructure. Whether it be automation in industry, all the way across industry, from factories to automation in cars to automation in homes, to automation of smart cities. All this automation, every one of these different, whether it be a street light or a traffic signal, that monitors things that are going on in the city, or devices that you have in your home, or automated driving functions. All of these things will have communication devices attached to them, and so the growth of that is big, and the company that has really the best the lock really on the patents for mobile communications devices is Qualcomm. And you've seen it has really started to perform in the last couple of months, really, since its merger with NXP was dissolved by Chinese authorities, basically refusing to approve of the merger. Qualcomm, ever since that event, Qualcomm has started to really take off, and I think that its growth rate, just based on the growth of 5G, as more and more devices other than just mobile phones start to get equipped with communications devices, mobile communications devices, I think it's going to really play well to Qualcomm's growth going down the road.
And Qualcomm is a chip maker with a intellectual property portfolio that's probably pretty staggering.
It is, and they basically have for high quality mobile communications chips. They have the patents that really you want to have the best quality product. You really have to do business with Qualcomm.
Right.
They don't make all the chips, but they either license or make most of the chips that are used in high quality devices.
I have to tell you, I got a direct message from someone on Twitter, and he interned with you over the summer, and I speak to him on Uranium once in a while on Twitter, and he told me that working for you over the summer was just one of the greatest experiences he's had in his young life. So not only are you a great a great wealth of knowledge on the markets and a really good investor, and but you apparently are a very good teacher as well. So kudos to that.
Well, thank you. I really enjoyed that experience as well. It's great to have somebody to do some research alongside me, and that was fun. It was a lot of fun.
No, that's great. I find for me I get a lot of people reach out and say, can I have 10 minutes of your time or something and I don't always have the time, but when I do, I'm always happy to share it because it's really enjoyable to see people who are excited and young and really want to work and learn. So it's fun. I can't thank you enough for your time. So tell us about the Vigilante Investor. I love reading it. I think it's one of my must reads. So I would suggest it to other people as well, so that they read it as well. So talk to us about how they get a hold of you and what it is, and give them a synopsis of it.
Yeah, Vigilante Investor newsletter. Almost 3 years old at this point, 2.5 years old, and been producing analysis, in-depth analysis on geopolitics and the critical effect that it has or is having on markets and investment opportunities. And I've been putting out stock selections that go along with that analysis. Ever since I started 2.5 years ago. If you want to learn more about it, go to vigilanteinvestor.com, and you can follow me. You can write to me if you have questions, and you can also follow me on Twitter at VI Investor.
It's always a delight speaking with you, and I always come away smarter, and I really appreciate your time.
Mike, it's always my pleasure. I mean, a chance to have a conversation with a guru like you, I can never pass that up.
All right, great. We'll have you on in a few months. In the interim, we'll be in touch, and it was great speaking, Steve.
You bet. Thanks, Mike.
Well, I hope you enjoyed the conversation with Steve. I love talking to him. We talk offline, and a really fascinating guy. And so I always, the second time now he's on the podcast, I'm going to endeavor to have him back a lot more. He's what I like in a newsletter writer. He's low-key. He's not promotional. He's not bombastic. He doesn't make outlandish predictions that have very little chance of coming to the light of day. He's just a good thinker and analyst. So really, really smart guy, and I enjoy the conversation. I hope you did too. I just want to let you know that I am the co-founder and chief investment officer at Sachem Cove Partners, LLC. And due to industry regulations, I don't discuss any of Sachem Cove's funds on this podcast. And all the opinions expressed by the podcast participants are solely their own opinions and do not necessarily reflect the opinion of Sachem Cove or its affiliates. And this podcast is for informational purposes only, and it should not be relied upon as the basis for investment decisions. Clients and or affiliates of Sachem Cove Partners may maintain positions in securities discussed on this podcast. We'll be back next week, and I haven't decided yet who we're going to have on, but hopefully we'll get a good guest for you. And in the interim, hope you have a great week and last week of summer. I know my kids aren't that excited about it, but hey, that's life, right? All good. Have a great week, and we'll talk to you next week. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.